you can all see the slides that I've got here that we're going to work through. So I'd like to say a big thank you to Tees Value Business for asking me to do this webinar. I know that there's a lot of you who have transactions or clients in the EU or who deal with the EU, and everything has changed fundamentally from the 1st of January. So I think it's really useful for us to get together like this so we can go through, you can work out what's changed and what you need to know. So to start off with then, our agenda, I'm going to cover a bit about Brexit, what it is, why it matters, why we're talking about it. Then we'll look at services to and from EU customers and how they have changed, buying goods from the EU, selling goods to the EU, transactions with Northern Ireland, which is a whole separate rule unto itself, and then a to-do list at the end, so you can work through that and make sure you're prepared for everything that you need to do if there's any changes you need to make as a result of what we cover today. So, Brexit. We actually left the EU in January last year, but then for 11 months we were in what was known as the transition period, which was time for us to get a deal sorted, get everything up to date and get prepared for when the transition period ended on the 31st of December. So from the 1st of January, from 11 o'clock on the 31st of December, we are outside the EU for all purposes, outside the customs union, outside the single market. So that's when all of these fundamental changes that we're talking about kick in. But we are still in the dark a bit. I'm sure you all will have seen the news and know that the Trade and Cooperation Agreement was actually only agreed on Christmas Eve, which gave us all not very long to absorb the 1,200 pages and work out how they will affect us. And that hasn't actually been ratified yet. The intention is that it will be ratified by the end of February, but we are to act as if it has been ratified, and on the assumption that it will be. We have some prospective changes to the VAT legislation, which still haven't been enacted, and the idea is they will be enacted from a certain date. We are assuming that date will be the 1st of January. The guidance was all updated in the last week of December. 60 pieces of HMRC VAT guidance were updated. But of course, the trouble is you just see that they've been updated until you actually read it. You don't know if that's because one line somewhere has changed from EU to rest of world, or is it that an address has changed, or is it that there is a fundamental change to that piece of guidance? So there's a massive amount to absorb. The guidance does appear to have been updated on the basis that all of the new legislation has been enacted. So even if it hasn't been, that's the assumption we're working on for the time being. And we'll just have to hope that it is, otherwise we're doing everything completely wrong. And speaking of legislation and things, it's probably just worth noting for anyone who's watching this on the recording, this is being recorded on the 13th of January. Things are changing regularly. I first started doing these webinars back in October, and every single week I've had to update the slides for things that are changing. So don't rely on this if you're doing anything other than today. I think you need to look up and just check. This can be your starting point, but you do need to check that nothing has changed in between now and when you're actually dealing with a transaction. So we've got buckets and buckets of new guidance. We've got the Trade and Cooperation Agreement, which actually doesn't affect VAT. So everything we were talking about last year hasn't changed as a result of the deal. We've got huge changes on the way goods are dealt with, most of which, from a VAT point of view, should be fairly easy to deal with. I think the more pressing issues will be import declarations and export declarations, things like that from the customs side of it. The smaller changes for services, and as I mentioned, that there are different rules for Northern Ireland, so we'll look at those separately. And I'll just have a sip of water before we move on to services. So the place of supply of services are covered in VAT Notice 741A, and that has been updated to take account of all the proposed changes to the legislation. So if you are supplying services to the EU or buying services from the EU or from anywhere else in the world, that link there that I've included to that guidance, that should be your starting point where you look for anything. The notice was updated on the 31st of December, so as far as I am aware, it is valid as it stands, as it is. So always look there first. The general rule, which covers probably 90% of services, is the same as it has been for the last few years. If you are making a B2B supply, so supply to another business, the VAT is due where the customer belongs. So if you are selling some advertising services to a company in France, the place of supply is France, it's outside the scope of UK VAT. If you are making a B2C, business to consumer supply, the VAT is due where the supplier belongs. So those advertising services, if you're supplying them to a consumer rather than to a business, if you're in the UK, you charge UK VAT. So that hasn't actually changed. That was the rule before and stays the rule now. The only difference is previously on a B2B supply, you would have included a statement on your sales invoice along the lines of this service is supplied under the reverse charge rules and the VAT is due in the country of receipt. And quite often you would refer to the European VAT Directive. You don't actually need that statement on the bottom of the invoice anymore. But other than that, there's not really anything that would change there. The exceptions to the general rule, which again, these are the same as they have been for a number of years, nothing's changed here. It includes things like land-related supplies. So if you are doing some work to a building, the place of supply is where the building is located. Doesn't matter where your customer is. If it's transport, if it's admission to events, they all fall outside the general rule. There's detailed guidance in that VAT notice, but things like admission to events, it's where the event is. So if you pay to get into a circus in Germany, the place of supply is Germany, so you would be charged German VAT on it. So none of that has changed, other than, as I say, the wording on the bottom of your invoice might be slightly different. What has changed, and I'd initially put the question mark because we didn't know if the legislation would be enacted, but as I say, the guidance has all been updated, so I think we act as if it has. The use and enjoyment rules kick in just for certain suppliers of services. So we've got the letting on hire of goods, B2B electronically supplied services, B2B telecommunication services, B2B repairs under insurance claim, and radio and television broadcasting services. They fall under what is known as the use and enjoyment rules. And they only kick in where the normal rules, the B2B general rule or the B2C general rule, depending which of these it is, would give a place of supply outside the UK, but the service is used inside the UK, or vice versa. So if you are providing a website, let's say, B2B electronically supplied service of a website to a German customer, but they are actually using it for their UK subsidiary, the normal rules would give you B2B, place of supply of Germany, but the use and enjoyment of that website is by their UK subsidiary. The supply is in the UK, so you would charge UK VAT. And that was always the rule for outside the EU, but now it's anything outside the UK. If the use and enjoyment's in the UK, but the general rule's outside, you charge UK VAT. If the general rule gives you the place of supply inside the UK, but the use and enjoyment is outside the UK, you don't charge UK VAT. So it's just one that you need to look at. And there was an article in December in Accounting Web by Neil Warren, which pointed out there might be an issue there where under our rules, the place of supply might end up being the UK, but under French rules, for example, it might end up being France, and you might end up with some double taxation. We haven't actually got an answer for that yet from HMRC as to how that's going to work. So I think it's just, if it might be an issue, it's just something you need to keep an eye on and try and dig down. Hopefully most of them it will be very straightforward and it will be either one place or another. Unfortunately, the guidance that was published, some guidance came out in December with transitional rules for what happens where supplies span the end of the Brexit transition period, but it doesn't actually seem to make any sense. It keeps referring to things that don't have anything to do with that part of the legislation. So with the VAT practitioners group have taken that up with HMRC, and hopefully we'll get some guidance which makes sense at some point. And the other thing which has changed, again, the wording of the legislation, the only thing that's changed is that a previous reference to outside the EU now is changed, so it's outside the UK. So there's a list in that VAT notice 741A of intangible services. So it's advertising, consultants. So actually advertising was probably a bad example that I used on the previous page, but you get the gist of services anyway. So it's only for business to consumer supplies of advertising, consultancy, accountancy, things like that. And normally, of course, as we said on the previous page, for B2C, the place of supply is where the supplier belongs. So if you were an accounting firm doing a tax return for an individual in Spain, you previously would have charged them UK VAT. From the 1st of January, those intangible services to a consumer are treated as supplied where the customer belongs. So if you do those accounting services, tax return for an individual in Spain, you no longer need to charge them UK VAT. So that's quite a big change there. But as I say, it's all in the notice, and that's your best starting point if you are doing anything. But most of it will be the same for you as it always has been, apart from those use and enjoyment rules and the intangible services. So I shall have some more water before we move on to goods. So if you are buying goods from the EU, you are classed as an importer, and you will need to make a customs declaration, an import declaration. So I'm not going into that in massive detail because that's not actually anything to do with VAT. Well, your VAT might be calculated as a result of what is on that import declaration, but the declaration itself is nothing to do with VAT, and you can appoint an agent to deal with that on your behalf if you want to. What you will need from a VAT point of view is an EORI number. So a lot of you may have one already, because when we were back in March 19, and it looked as if we might have a no-deal Brexit, HMRC issued EORI numbers to any businesses they thought might import or export goods. So you may have had one already. It's usually GB, then your VAT registration number, and then 3 zeros. If you haven't, you must have one of those numbers to be able to import or export goods. So you definitely do need to get one if you haven't got one. I was telling everybody for ages that it was easy and didn't take long, and then I thought perhaps I should put my money where my mouth is and actually have a go at it. So in December I did log on and I timed it, and it took me 3 minutes to apply for it online. So it really doesn't take you very long. It doesn't cost anything. You just need to enter some information about your business, your VAT registration number, your UTR, very little else. It's very straightforward. And you receive your EORI number immediately on the screen and it should be valid for use within 48 hours, and it should be searchable as well. So definitely do that. Number one job if you haven't done it already. So all imports over £135, and I'm covering consignments under £135 later on, but in principle, any imports you bring in, you will need to pay import VAT and duty. So those of you who've bought goods from outside the EU in the past, it's just the same as it was for all of those. That there's nothing different. It's just that now goods coming in from the EU are treated in the same way as goods from outside the EU were previously. I've mentioned duty there, but of course you will have seen the trade deal. There may well not be duty if the goods originate in the EU or the UK, but as I say, that's outside the scope of what we're covering. But in the past, if you've bought goods from the EU, what you will have done, your supplier won't have charged you any VAT, and when you've received the goods, you will have dealt with the VAT as acquisition VAT on your VAT return. So you charge yourself the VAT, and then you recover the VAT under the normal rules if you're entitled to recover it. Up until the end of last year, for imports, the rule was that import VAT was payable at the border, and then you recovered it on your next VAT return. So there was a timing difference and cash flow implications there. From the 1st of January, we have what's known as postponed VAT accounting, which means you can deal with that import VAT on your own VAT return. So what will happen, those of you who've imported from outside the EU before will be familiar with the C79 statement. They will cease, and instead, for everything you import into the UK from outside, so this is EU and non-EU, it's all one now, you'll be able to download a monthly statement from HMRC telling you how much import VAT you've incurred in that month. But as I say, instead of paying it at the border under postponed accounting, you deal with it on your VAT return. So it's almost like a hybrid between what you did with imports before and what you did with EU acquisitions before. It sort of brought it together as one. And this is one of those things that's changed a number of times. Initially, when it was announced, it was only going to apply to supplies from the EU. It wasn't going to apply to supplies from outside the EU. Then in February last year, it wasn't going to apply to anything because we had plenty of time to prepare for Brexit. Everybody was going to be absolutely ready for it. There was no need for postponed accounting. All that would be payable at the border. Then 2 months after that, it was announced that actually you could use postponed accounting for everything, for EU and non-EU. So it's changed a lot and flip-flopped about on the way there, but we're now at the position this can apply to everything. So the way it works is you don't pay any VAT when the goods arrive in the UK, and there will be a box on the import declaration to I think you have to put a G in one of the boxes, or whoever is dealing with the documentation for you will do that to say that you're using postponed accounting. And then you download this statement that tells you how much import VAT you owe for the month or for the quarter if you're doing quarterly VAT returns. You include that import VAT in box 1. If you can recover it, depending on whether you're partially exempt or whatever it is you've brought in, you include the same amount in box 4, and you include the net amount in box 7. So I know cloud-based software that most people use now, of course, is good because you get the updates automatically without having to change anything. I've not looked at all of them yet, but I do know that Sage is using box, is it T15 or T20 something? Sage has updated its codes, so you will be able to look in Sage and find a specific code which deals with this for you. If you use any other software, I would have thought that they would have updated it now and be on the ball. So definitely that is a cash flow benefit, that there's no requirement to pay that import VAT upfront. But of course, it's not just VAT. Obviously, from what I've said, that's very straightforward. You don't pay VAT when the goods come into the country. You declare the VAT on your VAT return, recover it on the same one. As far as VAT goes, that's pretty straightforward. But there's not just that you need to think about. I've mentioned duties here, which, depending on how the origin of your goods, whether they come from the EU or not, there might not be any duties. But you have got admin costs because you've got a customs declaration that you've never had to do before. So you need to bear in mind whether you need to increase your prices to account for that. You need to submit that SAD C88, that's the import declaration. You need to think about whether you're going to do that or whether you're going to get an agent to do that. You need to think about your Incoterms, which might not have been something you've thought about much before, because an EU seller will have just packaged up the stuff and sent it to you. That there's been no borders to worry about. But the Incoterms could go from X works, where you take ownership as soon as it leaves the seller's warehouse, to delivered duty paid, where the seller is responsible for it until it gets to you. And depending on the terms, the VAT is due at different parts of the journey by different parties. So you just need to have a think about that and chat and make sure. What you don't want is the seller thinking you're responsible for it and you thinking they're responsible for it and nobody dealing with it. Or the other way around, you don't want both of you thinking that you're dealing with it and end up accounting for VAT twice. And also, I mentioned this with VAT, even though it's not technically VAT related, but just because your accounting records might be the place to record it, you need to collect much more information than you've ever had to in the past. For the things you're bringing in, you need to know the commodity code, you need to know the customs value, because the VAT is based on that. You need to know the origin details of those goods. So you need to have a think about how you're going to capture and record that information, and your accounting records, your VAT records, might be the place that you decide to do that. So I'll just have a sip of water and then we can move on to Star Trek. So this, I just love this bit, because I never thought when I started specialising in VAT that I would get to quote William Shatner on VAT. So when I found this treat, I was quite happy. So what he said, I mean, you can read it for yourselves, but he said, the UK government is forcing vendors outside the UK to collect VAT on orders being shipped to the UK from the 1st of January. His staff have looked at the costs, and it's looking at £1,000 a year just to file the VAT returns. It's too much to absorb without putting the prices up massively. So stopping selling to the UK, full stop. And obviously that was back in October, but since then, I'm sure you will have seen in the news, there have been a number of high profile businesses. I think I read an article over the weekend that had found at least 140 businesses who have said they will stop selling to the UK as a result of this. So what happens, have I done a slide on this? Yeah, so if the consignment value is under £135, and that's the total consignment, not just per item, so you could potentially get around it by ordering a lot of things together. The place of supply moves from the place of import, i.e. the border, to the place of sale, i.e. where the customer is. So instead of the customer accounting for import VAT, the seller has to register for VAT in the UK and account for VAT on that sale. So if you have a seller in France who is selling a CD to a UK customer for £10, that French seller will have to register for VAT in the UK and charge UK VAT and deal with any import documentation. Now, I've mentioned an online marketplace there because it is different. If you use an online marketplace, they will be deemed to be making the supply. So that might be one way around it if businesses are struggling with this. If they sell through an online platform, that they can deal with the VAT without the seller having to register in the UK. And I've put there also B2B supplies can be excluded if the customer's VAT registered. So if you are a VAT registered business and you're buying something for £100, say, you can say to the seller, by the way, I'm VAT registered, can we deal with this under the normal rules? And then we would go back to what we covered on the previous slides, where the seller wouldn't charge VAT and you would deal with the import VAT on your return. But obviously this is a massive issue, and it is stopping. The idea is that it levels up the playing field, so people aren't buying things from France, Germany, Spain without VAT when they could be buying them from the UK with UK VAT on it, to even it up so everybody's paying the same amount of VAT. It's given businesses a bit of a shock, obviously, although it was announced quite a long time ago. But the interesting thing is, you'll see when we come on to selling goods to the EU is bringing in a similar rule, but not until the 1st of July. So a lot of businesses, for example, William Shatner with his Star Trek memorabilia, has decided to stop selling to the UK. I don't know if he's realised that it actually applies to the EU as well from the 1st of July, and whether that means he will stop selling there, or whether he will come up with some sort of solution. So it'd be interesting to keep an eye on it, but definitely we might see a lot of overseas businesses will either have to register for VAT in the UK, or will just stop selling here, and we'll lose those products, which would be a shame. So I shall let you absorb that. I'm conscious that this is all very technical, very, very high level stuff and fundamental changes. So there's a lot to take in. So I'm trying to pause every now and then so you can absorb what we've said. So I'll just have a little bit more water before we go on to selling. So selling goods, you've bought all your goods, you've got them here, you've got your stock. Now you want to sell them, but you want to sell them not just to the UK, you want to sell them to customers in the EU. So you will need an EORI number, as I mentioned earlier. That is, if the goods are crossing the UK border, if they're coming into the UK or if they're leaving the UK, you will need that number. So as I say, very important, number one thing to do if you haven't got one. The customs declarations, the import and export declarations, cannot be completed without that number. So the goods just won't go anywhere. There'll be one of those trucks in traffic jam in Kent backing up everywhere that gets shown on the news all the time. You might need export licenses and certificates. So even though we've got this trade deal that covers duties and quotas, that there are still some things which need a certificate. You may well have seen on the news stories about food that's going over and livestock needs to be checked by vets before it goes. So some things do need to be certified, and that's going to take extra time because it wasn't needed before. So you need to, and extra costs. So you do need to build all of that into your planning and your pricing. You must complete an export declaration. The goods can't leave the country without that export declaration. And again, I mentioned you can use an agent to do that for you, unless you've been doing non-EU sales for quite some time and are familiar with the rules. I would certainly recommend using an agent, because one little mistake can hold up the whole consignment. And the only issue is, of course, the agents are rather busy. I think the latest figures I saw previously, the UK made 50 million declarations a year, and the estimated number of declarations after Brexit is 265 million. So it's a massive increase, and we haven't suddenly got masses more customs agents who can deal with that. So do start speaking to somebody sooner rather than later if you need someone to do those declarations for you, and that they'll be able to talk to you and see if they can fit you in and help you and give you some direction. So from a VAT point of view, for selling the goods, it's probably much more straightforward than it was before. As long as you have evidence that the goods have left the UK, you can zero rate that sale. So there's different rules if the customer's collecting the goods, but generally, if you are sending the goods to your customer, you will have evidence, because you'll have your export declaration, you'll have your sales invoice, you will have the bill of lading or the shipping documents or the proof of postage. You will have something to show that the goods have left the UK, and there's detailed guidance from HMRC as to what they will accept is evidence and what isn't evidence. So you can zero rate that sale. So all that you need to do is include the net amount in box 6 on your VAT return, and that's it, nothing else. But you do need to make sure you keep that evidence of export, the evidence that the goods have left the UK, and that is something, if you ever have a VAT visit, HMRC can ask to see that evidence, and if that evidence isn't there, they could assess you on VAT that hasn't been paid. But of course, someone has to pay VAT somewhere along the line. So what happens is your customer will probably be liable to import VAT and duty in the country of receipt. So if you sell a table to a customer in France, that customer at their end will deal with the import VAT on their VAT return and any duty, if there is any. So it's the mirror image of what we were talking about when we were mentioning buying goods from EU countries. So some businesses I've spoken to have actually decided to register for VAT in the EU because their customers have just said, no, we're not dealing with duty, we're not dealing with import VAT, we just want to buy the goods, and the price we see is the price the goods are, full stop. So some people are registering for VAT in the EU, possibly in the Netherlands, and having a distribution hub there. That seems to be a very popular location. Or also Ireland is very popular because obviously they speak English, so all of the guidance, all of the VAT registration forms are in English, which certainly makes it easier to complete than trying to do a VAT return in Greek, unless that's your first language. It's quite tricky because it's not the terminology that you'd be familiar with. You might know enough French or German to go on holiday there and order a cappuccino or a pizza or coffee or whatever it is you're going to have. You might not know the terminology for value-added tax and exports and imports and certification and things like that. It's not what's normally covered in foreign language classes. So it is tricky. There would be extra costs involved in an EU VAT registration, but sometimes to streamline the customer process, and you'll see more when we get on to talking about selling goods to consumers, where you might not have a choice anyway. You might just have to do it. So at the moment, if the goods are valued less than €22, there's no import VAT and duty. So if you are selling a CD to a consumer in Portugal for £10, that would be under the €22. You don't have to charge any UK VAT because you've got proof of export, and the customer doesn't have to pay any import VAT and any duty because the goods are under the €22. If you are selling to that same customer in Portugal, if you are selling them a special limited edition LP that's £50, that value will be over the €22, so the customer will be liable for import VAT and duty. So when it's a business, it's perhaps not so much of an issue because the businesses will be dealing with these sort of things all the time. For that customer, in the past, if they've bought a £50 record from you and you've posted it out to them, you charge them UK VAT and they've not had to worry about everything. So the cost might have been slightly higher, but there was no hassle for them. Now, the cost might be slightly lower because you don't have to charge them UK VAT, but they should get a letter from their version of Royal Mail saying, we have some goods for you, we will not release them until you pay us import VAT and duty, if duty applies, plus an admin fee. I think Royal Mail, it's £8.50 or something like that. I don't know what it is in other countries. So you've got to think, will your customer still want to buy that record from you if they've got import VAT and potentially duty and admin costs and the hassle of having to pay that before the goods are released to them? But the only way you can avoid that is if you register for VAT in the EU, which you might not have a choice later on, but for the next 6 months, you do have a choice. So I've talked to lots of businesses who are handling it in different ways. Some have just said, well, actually, nearly all of my customers are in Ireland. I'm just going to register in Ireland, and then they don't have the hassle and they'll still buy from me. Whereas some have said, well, actually, we don't have very many customers in the EU compared with our UK customers. It's not worth us registering there, because obviously if you register in the EU, you've got the cost of the VAT registration, possibly needing fiscal representation. You've got to get to grips with rules you're not familiar with. It puts you at risk of VAT visits and investigations in other countries. If you've only got a few customers, you might just say, well, it's not worth it. The customer can deal with the import VAT and duty, like it or lump it, basically. So it comes down to a business decision, and it depends on who your customers are and what you're selling, really, and how they're going to deal with it. But from the 1st of July, the rules will change again for goods up to a value of €150. So that €22 disappears. That's not relevant anymore. And any goods up to €150, the place of supply will be where the customer is located. So in the same way as we've got in the UK now, from the 1st of January, that will apply in the EU from the 1st of July. So if you've got two choices. The first one is register for VAT in every single country in which you make sales up to €150 to consumers. So if you have a special product that only Italians like, and you only sell in Germany, and in Italy, sorry, that would be the country to register in. That's probably the way to do it. But if you sell all over the world, and that includes 27 different EU countries, I'm pretty certain you will not want to register in 27 different EU countries. But luckily, what's coming in is the one-stop shop, which should make this slightly easier to deal with. So any of you who supply electronically supplied services may have heard a similar phrase before, with the mini one-stop shop, which applied to electronically supplied services to consumers. And this is very similar, but it's going to cover all of these goods. E-commerce it's referred to, because it's generally people buying things online that are posted out to them. And what the one-stop shop does is allows you to register just in one country rather than in all 27 EU countries, and you will submit one return in that country, which will have 27 lines on it, one for each country. So you still have to charge your French customers French VAT, German customers German VAT, Spanish customers Spanish VAT, and so on. So you do have to have something built into your accounting system. Some people just say, well, actually, we'll pick the country with the highest VAT and give a VAT inclusive price to everybody, which accounts for that. Some will have their websites adapted to each country, so that if somebody's looking at it in Spain, they'll only pay the value of Spanish VAT. If it's in France, they'll pay French VAT, and so on. It depends on the type of things you sell and how flexible your customers will be about the price. But what you do then is you submit this one-stop shop return, which has 27 lines on it, one for each country, and you just show country, amount of sales, amount of VAT, and you total up that VAT and pay it in the country in which you are registered. So you may have heard of the distance selling regulations, and that's what this is replacing. The distance selling regulations allowed you to charge the VAT rate in your own country until you reach the distance selling threshold, which is 35,000 or 100,000 euros, depending on the country. So if it was a country with a 35,000 euro limit, as long as your sales to that country were below that amount, you'd just have charged UK VAT. That only applied to EU countries anyway, so stopped for us from the 1st of January, and from the 1st of July, stops for everybody. As far as I am aware, these rules are coming in on the 1st of July. The intention was that they would come in on the 1st of January, but they've been put back because of COVID, because the assumption was that people wouldn't have the time to prepare for this and be ready, because it is quite fundamental changes. So they were put back from the 1st of January to the 1st of July. I've not seen anything suggesting that they will be put back again because of COVID, but I think it's something we just need to keep an eye on. And the actual guidance available yet, that there's not a massive amount of guidance because it was put back. So it's something that you need to keep an eye on. I think if it's going to apply to you, keep an eye on it over the next few months and see where it takes us. But you wouldn't need to register in at least one EU member state and file a non-union one-stop shop return, which should be available before before it actually needs to be done, so we can see how it works. There aren't actually any examples yet. I'm just assuming it will be very similar to the mini one-stop shop return. So, you need to consider Incoterms, which I've already mentioned. So they're vitally important, because whoever is responsible for the goods at different points of the journey dictates who's responsible for the import and export declarations and for the VAT. So you need to have a look at them and have a chat either with your customers or your suppliers and work out who's responsible for what. Obviously, the most straightforward way is if you're buying goods from the EU, you want the seller to be responsible until we get to the UK border, and you want to be, so they're exporting from the EU and then you import into the UK. What you don't want is for you to actually buy the goods in the EU and be exporting them from the EU as well as importing them into the UK, because then you might end up having to have an EU VAT registration. So it's something to be careful about. Consider the issues if you're importing to the UK and then exporting to the EU. So again, it's just looking at ways to streamline the process. If you are bringing in some computer equipment from America, keeping it in the UK, and then selling it to Holland, you may then have two lots of import and export declarations to deal with. The VAT shouldn't be an issue, because it might be a cash flow issue, but it should flow through the system and not actually be a cost. But you're going to have more admin costs than you have before. Have a think about whether you want a distribution hub in the EU. If your suppliers are in the EU, it might be easier for you to rent yourself a warehouse in Holland, keep all the goods there, buy them from your EU supplier there, and sell them to your EU customers there. So then you're within the previous EU rules that we're all used to from before Brexit. You might need a fiscal representative if you have to register for VAT in some of the EU states. I think at the moment it's 19 out of the 27 countries that need a fiscal representative. I can't remember off the top of my head which countries there are, but some countries you do need a fiscal representative to register for VAT in that country. So again, that's an extra cost, because you're paying someone to have joint liability with you on the VAT. Have a think about whether it's worth selling via a platform. If you're selling to the EU and you don't want to have to register for VAT in all these EU countries, maybe just let a platform deal with it for you. It depends on how much you're going to be selling and what you're going to be doing. It might not be worth the hassle for just a few sales. Intrastat reports, those of you who've done them in the past will know what I'm talking about. If you haven't done them in the past, you still don't need to worry about them. Only some of them are required, some of them aren't. EC sales lists will only be required for Northern Ireland businesses, not UK businesses. So that's one nice thing. People can cross them off their to-do list every month, every quarter. Have a think about customs warehousing and free ports. Now, it might not be massive issues if everything you deal with has a country of origin in the EU or the UK after the trade deals come out. But sometimes if you're bringing stuff into the UK temporarily, which you know will be shipped out to another country, if you have it under a customs warehousing procedure, the import VAT and any duties don't actually kick in, because the goods can then be re-exported. Again, not going to go into that in great detail. I think you probably need a whole separate webinar on customs declarations and things like that, which isn't really my area, but it's just to make you aware of the sort of things that you need to think about. And then we have Northern Ireland. So the issue, of course, is we don't want a hard border between Northern Ireland and Ireland. But Great Britain, or the UK, is not part of the EU anymore, not part of the single market, not part of the customs union. So how can you possibly get around having a hard border there? So what we seem to have done to avoid that is move the border from here to here. So it's actually between Great Britain and Northern Ireland. So a lot of the guidance, a lot of the notifications and articles that you look at, you'll see different references. There's UK and there's GB. And the UK, if it refers to the UK, it is a rule which applies to all of the countries of the UK, including Northern Ireland. If it refers to GB, it's England, Scotland, Wales, and not Northern Ireland, and Northern Ireland is often listed separately. The services, if you supply or buy services in Northern Ireland, the rules are exactly the same as the UK rules. So everything we've already covered here, you'll just follow in the same way. I've put a link there to the government guidance, because this is being updated regularly. So I suspect even by the time I've got to the end of this presentation, the rules may well have been not changing exactly, but being clarified, because I think everyone's found it quite difficult to get to the bottom of what the rules are. So I would certainly recommend, if you do any trade with Northern Ireland, have a look at that article. There are also some rules called the Northern Ireland Protocol, which set out the rules, and you can sign up for what is known as the Trader Support Service, and that's for businesses in Northern Ireland to sign up to get help with customs declarations and advice on VAT, and it's all free. So if you're doing anything with Northern Ireland, if you Google Trader Support Service, you can sign up for it free. You'll get a password and log-on details, and there's vast swathes of information there which will help you work out what you need to do. Because the issue is, Northern Ireland is still part of the EU for the VAT rules, and GB is not part of the EU for VAT rules. So if you have a table, if you have a company in Northern Ireland who sells a table to Spain, you treat that as you would have treated it last year. Nothing's changed. The new rules we talk about here haven't applied. It's just the same as it always was for EU sales. But the issue, the reason I'm suggesting looking at the guidance is because it really doesn't seem very clear at the moment. All of the initial articles I read suggested that if you sold goods from GB, so from London, to Northern Ireland, so selling something from Newcastle to Belfast, for example, there would be import VAT due on that. So instead of charging VAT as you normally would, you wouldn't charge VAT, and the customer in Northern Ireland would deal with it on their VAT return as import VAT. However, the guidance that I've put the link to there, which is the most recent publication, says not. It says if goods are sold from Great Britain to Northern Ireland, it is a domestic sale and you charge VAT in the same way that you normally would. You don't have to worry about import VAT. So I would definitely suggest signing up with the Trader Support Service if you're going to trade in goods between Northern Ireland and the UK. There's an XI reference EORI number, which you'll need if goods are going if you are based in Northern Ireland or have a presence in Northern Ireland and have goods leaving the country. And there's even more special detailed rules on onward sales, VAT groups, moving your own goods. So if you move your own goods, if you've got a warehouse in Belfast and you've got a warehouse in Stockton, you move some machinery from Stockton to Belfast, you will actually charge yourself import VAT on that movement, which is why I'm puzzled by the fact the guidance says there isn't import VAT when you sell to someone, because why would there be for one type of movement and not for the other? So I hate it when I can't give an actual definitive answer on something, but unfortunately everything's still coming out. We're just going to have to keep an eye on the guidance and see what happens there. And if you are doing anything with Northern Ireland, just do be careful, look it up and make sure you're doing it right. So, to-do list. Obviously, hopefully, what I've talked about today will have already sparked lots of ideas with you thinking, oh, I need to check that, I need to do this. But just as a guide, some things that I've found useful for people to do. Have a look at your supply chains and have a think about, are you making any sales cross-border? Are you making any purchases cross-border? It might not be immediate purchases. It might be something you're buying from a UK supplier who is buying it from Italy, but it's just making sure you know where those supply chains are, so you know where there might be sticking points and you're ready to deal with it. Apply for an EORI number. I think I've harped on about that enough, haven't I? Have a think about whether you're going to make those customs declarations yourself or use an agent. As I say, the agents are under a lot of pressure, so get in touch with one sooner rather than later if you are going to need one. There are grants available if you'd like to train to do it yourself, but is it worth it if you're only going to do one every now and then? You're probably better off paying somebody to do it for you, and then at least you know it's right and you've got some comeuppance if it goes wrong. If you do it yourself and it's wrong, then it's just tough cheddar, really, isn't it? Have a think about whether you need an EU VAT registration, because I know obviously there's a lot going through at the moment. The last one I looked at was one in Greece, and we were told it was going to take 6 to 8 weeks to come through. So if you know you're going to need a registration to sell goods there, you need to crack on and get it done. If I don't know a great deal about EU VAT registrations, so I only specialise in UK VAT, but I can put you in touch with specialists. So if anybody does need an EU registration, drop me a line and I can give you their contact details. Agree the Incoterms with your customers and suppliers, so everyone knows who is responsible for what, when. It might be that they're already in your contracts, but nobody's ever looked at them and thought about them, and they might not reflect the actual position at all. Now, I'd included this originally before we knew about the deal. Consider applying for deferment schemes. That's where, when duty is payable at the border, you can apply to defer it and just pay HMRC by direct debit the 15th of the following month. Might not be such an issue now because of the trade agreement, but it's something that's worth thinking about, and they're actually easier to get now. You used to need a bank guarantee, which would have been a prohibitive cost and probably not worth it for what was a maximum 6-week cash flow benefit. Now you don't actually need a bank guarantee in most circumstances, so it's worth thinking about. Have a think about whether you need to change your accounting software. As I say, Sage has definitely updated because I've seen their new tax codes. I would have assumed all the others have as well, but you need to make sure that as well, whoever is entering the information into the accounting software knows about the changes and knows how things should be treated. And have a think about how you're going to collect all that extra information you need. Is it going to be part of your VAT records, or are you going to keep it somewhere else? And that is just about everything I wanted to cover. So we can circulate the slides afterwards, so you've all got a copy anyway. But you'll see here, Tees Valley Business have got an EU exit support helpline, and there's an email address there. So if you get in touch with them, they've got a whole team who can help you with any issues that you're having in relation to Brexit. And they also have got one-to-one support available for businesses. So they really should be your first stop for getting guidance. If there's anything you're not sure about, anything you need help with, they would be happy to help you. So what we're going to do now is stop the recording, and we will see if anybody has any questions.